There are plenty of investment strategies that are low skill, putting your money in a high interest bearing bank account, buying an index fund on the stock market. These are low skill, and low skill is not an insult. Low skill is a positive characteristic of an investment, which means you don't need to be really good at it to get a good return. Well, angel investing is not like that. If you want any hope of a good return, it's high risk regardless, but if you actually want the odds to even be in your favor, you need to know what you're doing.
You're listening to the Startup Podcast. This is an educational episode, in-depth masterclasses about the concepts essential to building, running, and investing in Silicon Valley-style startups. Whether you're a founder, investor, or operator in a startup, you'll gain insights into the principles that power high-growth disruption the same way Facebook, Google, and Uber do it. The conversation starts now.
Hey, I'm Chris Saad.
And I'm Yaniv Bernstein. And in today's episode of the Startup Podcast, we're going to talk about angel investing. This is an area that is shrouded in mystery, but it is becoming more and more common. And people are always asking us, should I be angel investing? So we are here today to demystify it for you. We're going to talk about what angel investing actually is. What sort of person should be doing it? Why do it? Apart from making money, what is the point of angel investing? What are some of the things you need to watch out for? Why maybe you shouldn't do it? How you get into it, the difference between direct angel investing, syndicates, SPVs, and more. And finally, should founders be angel investing? Can't wait to get into this show right after this break. There's the stuff you need to do to grow your startup, and there's everything else. HR, IT, payroll, expenses, and more. Rippling handles everything in that second bucket, no matter where in the world your employees are. There's no such thing as a silver bullet, but Rippling kind of is one. No wonder they're growing so fast. Get your first 3 months free by visiting rippling.com/TSP. That's rippling.com/TSP for the Startup Podcast. Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for SOC 2, ISO 27001, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. And it gets even better. Just for TSP listeners, you can get $1,000 off Vanta when you go to vanta.com/TSP. That's VANTA.com/TSP for the Startup Podcast to get $1,000 off. Okay, now just before we crack in, it is time to talk about the Startup Podcast Pact. We love getting new listeners. It really helps us grow the show, keep doing what we're doing, and get the best guests in and the best topics for you. So if you haven't done so already and you like our show, please follow us in your favorite podcasting app. Leave us a review, ideally on Apple Podcasts, and follow us on YouTube. It's a massive help. It's all we'll ever ask from you. Thanks so much. So first of all, Chris, we want to talk about what is angel investing. And I've got to say, I hate the term angel investing. It sounds extremely self-serving and self-aggrandizing. There's nothing angelic about angel investing. So let's put that term to one side. Unfortunately, we are stuck with it. But talk about what people mean when they talk about angel investing. So angel investing in startups is done by individuals rather than by funds. A fund has its own investors. It has its LPs, limited partners. And so a VC fund is investing its money out of that pool of capital that is not their own. When you're an angel investor, you're investing your own money. And partly because of that, the checks are usually smaller. And that also implies that it's usually done at early stages. So none of these are hard and fast rules. But the general angel investor is someone who is writing a relatively small check, and we can talk about what we mean by a relatively small check in a moment, at a relatively early stage of the company, sort of pre-seed, seed sort of stage. You generally don't get angels jumping in at Series A or Series B.
Yeah, so just to put some more specificity about each of those terms. So a fund is typically a pool of money from other people. So you go around asking for money from typically large institutions, right? Like pension funds or funds of funds or sovereign funds or what have you. They have typically pretty deep pockets. They carve off some part of their money and they put it into a VC fund or an investment fund. And then the partners in that fund they're professionals. They're hired by the firm. They go out there and they vet startups and they invest other people's money and get returns for other people. And there's, incentives and reasons they do that, salary and a carry on the fund. We'll talk about carry later. So by distinction, as you said, Yaniv, the angel is investing their own money, the money in their bank account. And maybe they made the money through traditional business. Maybe they made it by being a founder in another company that had a great exit. Maybe they came from a wealthy family. It doesn't really matter. It's typically their own money and they're putting it in. And as you said, Yaniv, they're typically smaller check sizes. Now, of course, running around Silicon Valley and New York and some other major hubs, there are some very, very wealthy people writing some much larger checks, 100K, 200K, 500K checks, which are on the larger side. But, we're talking about generalities and averages here.
And I think there's a couple of other things that are maybe, again, not hard and fast rules, but I think generally the case. And the first of those is that angel investors tend to be part-time investors. They tend to have a day job or they're retired because they've made lots of money, to your point, from a big exit or whatever. And they do this angel investing as somewhere between a hobby and a side gig and giving back and a bunch of other stuff. If you're a full-time angel investor, I would argue you're stretching the credulity of the term. You're nearly at that point running a small, one-person family office. You have to have a lot of money. You have to be investing a lot of money to do this full-time. At that point, the dynamic is somewhat different. And I mention this because although it's not a formal part of the definition, this means that the angel investor comes with a certain type of approach. They are doing other things and they're doing this on the side, and their motivations are a little bit different to just a straight down the line VC or someone who's trying to maximize a return on a pool of cash. They do it for somewhat different reasons. And of course, I have to say angel investing is a very high risk, high reward activity. We will come back to that, but especially the high risk aspect of it is really important for people to understand, because I think angel investing is in a sense becoming democratized, or more than it used to be, right? More people are doing it than ever. And it is investing, but it is also a gamble much more than buying an index traded ETF in the local stock market. And so it's really important to understand that aspect of angel investing.
Another part of what is angel investing, and this might be obvious, but not to everybody, what you're doing is you're giving money to the startup in return for one of a couple of things. Either what's called a promissory note, often referred to as a safe, which is a kind of note, where they will later give you a piece of the company based on a valuation that someone else sets in the future, or in return for buying a piece of ownership in the company, typically a de minimis amount, a small amount, right? This is not like a business partnership where you're buying 30, 40, 50, 60% of the company. Just to be very clear, it may be obvious, you are buying a piece of the company or the right to a future piece of the company at a valuation to be determined. And you're doing it to watch that company's value grow, hopefully by leaps and bounds, 5x, 10x, 100x, in some very lucky cases, thousands of x. And then when that company sells, either in part or in total, you get a large chunk of change back. It's grown because of the value of the company has grown. You're not investing, for example, for dividends. You're not investing for a piece of the revenue. You're not investing for any of that other nonsense. You're certainly not investing for control because you want to be silent in that relationship, but you are investing for a piece of equity that will later be worth hopefully much, much more, or more often, zero. High risk, high reward for sure, right? If you think about the spectrum of risk to reward ratios, maybe on one side might be cash in a good economy or in a good country. Maybe there's property over to the right a little bit, again, in a good property market, good economy. Somewhere in the middle there is public equity markets like the stock market, basically. And then over to the right, you're starting to play with angel investments and crypto and all this kind of stuff. Although crypto has been more stable than the stock market. But maybe over the right, you're talking about blue chip crypto. And then over towards the far right is altcoins and angel investing. You basically, when you're writing one of these checks, you basically got to imagine that your money is just evaporated. It is a high risk thing. You need to invest money that you can afford to lose, and you need to invest it without a sense of paranoia where you're like breathing down the neck of the founder every 5 seconds. You're not their business partner. You're not a co-owner, although you might, ultimately end up owning a little bit of the company. And, it's not this traditional, like, I'm going to go into business with you and I want 40% type thing. It's like, we'll talk about the mechanisms and the percentages a little later. But for all intents and purposes, you're a relatively silent investor. We'll talk about this, but you'll earn or you'll deserve some amount of communication, but you should not be showing up asking the founder what they're doing every day and having any kind of influence over what's going on.
One final point to make on that, because angel investors are typically part-time, because they're typically doing other stuff, usually in the startup space, they're also often considered by founders as value-add investors, right? So as a founder, you take an angel investor's money, but you're also hopefully getting access to their expertise, to their network, to whatever it is, to their prestige sometimes that you're looking to get from them. But I think it's important to understand, so that's the investor's side, but it is the investor's prerogative to take the benefit of that, right? You don't want to be inserting yourself as an angel investor. You want to be making yourself available to help. That's an important thing to do.
That's actually worth digging into a little bit, Yaniv. Who should be an angel investor and who should take money from angel investors? You said that you would hope that an angel investor is value add. I think that's the ideal, very much the ideal. If you're a sophisticated founder who knows how to go get money, who knows how to tell a story, who's maybe earned that sort of thing, it's ideal that your angel investors are value-add investors. The reality is in many places, in many communities, you're just trying to raise money from any high net worth who will give you a check. And that's why I especially point out, like, especially if you're not a multi-time founder with value to add, then give your money, sit quietly, and bet on the person that you've invested in. I think it's really important. And then who should raise angel money? And we've talked about early stage fundraising in previous episodes. It's people who are at the early stages. As you said, angel checks tend to be small. Your company tends to be at the early stages needing smaller amounts of money. Before you go institutional, before you go to the official funds, you want to look at your friends, family, fools, and people who are doing angel investing regularly and say, hey, I need a check. It's early days. I'd like you to bet on me and we'll see how this goes. High risk, high reward. Come along on the journey.
First of all, you mentioned fools, and we've talked a lot, Chris, in the past on this show about not taking money from fools because you will come to regret it.
We've definitely talked about don't listen to fools, but if you're kind of desperate, you might need to take money from fools.
And maybe it's a valuable distinction, looking at it both from the investor side and from the founder side, which is probably where that term angel came from in the first place, is this sense that it's an investor who is also a mentor, who is also a helper, is value add, right? So in a sense, an angel investor is somewhat value add, whereas family and friends or just kind of people who are looking to park their money somewhere are not value add. And I would nearly hesitate to call them angel investors. And I don't want to get too caught up on the terminology, but it's different. To your point, Chris, like as a founder, you need to handle them differently. As an investor, you need to behave differently. But also I think the type of communication needs to be different, right? Because angel investors tend to be insiders who know the game that's being played. The family and friends round has kind of died out in favor of pre-seed or angel rounds. And that's because taking money from family and friends is sometimes something you have to do to get the money, but it is fraught with risk, Chris. You know, unless your family happen to be a bunch of Silicon Valley founders, this is very uneducated capital. And it is capital that is also highly emotionally attached to you. So you're actually doing something that's really problematic for you. You're taking on a type of cap table debt when you are doing family and friends or dumb money, early stage private investment, right? Because what's going to happen is, of course, if everything goes well, you've made your family and friends rich, you're a fucking hero, right? But as we know, things don't usually all go to plan. And if things start getting difficult, when the road starts to get rocky, your family and friends are not going to understand why they still haven't seen a return, why it's still not profitable, why you're taking a down round and diluting them. Like all of that is going to be problematic. So I think I do feel, Chris, I've changed my tune on this in just the last 10 minutes. I think we should reserve the term angel for someone who provides something more than just their money.
I think the distinction you can draw, I did say friends, family, fools, and angel investors, right? So I do think they're different categories. I still think there are angel investors running around in second, third, fourth tier markets who are not value add, but who are doing a lot of investing.
Oh, no, so here's the thing. They call themselves angel investors.
Yeah, now we're in semantic games. I think if you're writing checks regularly into startups with some sense that, hey, this is a strategy of my portfolio, but you are not a former startup operator, investor, insider, you are still what I would classify as probably dumb money, but you are doing this as a concerted effort because you've decided it's part of your investment strategy. And you're not related to the founder as a friend, family, or fool, I would say you're still an angel investor. You're just not a very good one.
Okay, fair cop. But we're in the question of like, who should be doing this, right? And one of the things I actually had it a bit lower down our list, Chris, but we can bring it up now, as to one of the reasons why you may not want to be an angel investor is it is a high skill investment strategy. There are plenty of investment strategies that are low skill. Putting your money in a high interest bearing bank account, buying an index fund on the stock market. These are low skill, and low skill is not an insult. Low skill is a positive characteristic of an investment, which means you don't need to be really good at it to get a good return. Well, angel investing is not like that. If you want any hope of a good return, it's high risk regardless, but if you actually want the odds to even be in your favor, you need to know what you're doing. You need to be good at identifying good startups and investing in them appropriately. So the question is, who should do it? If you are not someone who understands enough startups to be good at investing in them, and therefore you're also someone who is not good at giving them any useful input or advice, you're not value add, you just probably shouldn't be doing it. And yes, of course, the fact that you shouldn't be doing it doesn't mean that you're not. There are plenty of people who are doing it and shouldn't be doing it. But to answer the question, who should be an angel investor, I would say you need to be some degree of insider, meaning you need to understand startups in order to be able to make this a viable investment strategy.
Another consideration when you're thinking about whether you should do this or not is that it's really about portfolio strategy as well. We've said a couple of times already in the episode, it's high risk and your money is likely to evaporate, which is why you need multiple bets. If you do like an investment once a quarter or once a year or 2 times a year, you're likely to just be pissing away your money. Typically, you want to be thinking about something like 10 investments a year or more. And so if you have $100,000 allocated to this from your portfolio a year, then you want to really be divvying that up into $10,000 checks. And also in the perfect world, you want to be thinking about doing this for 2, 3, 4, 5, 6 years. That's really the way sophisticated angel investors in Silicon Valley think about this. And so they think about how much capital they have, how many checks they can write, and how long they can sustain this, because they understand power laws, they understand portfolio theory, and they understand the distribution of risk across their portfolio.
In fact, a really experienced angel investor who we've had on the podcast before a long time ago, Matt Allen, he has a sort of thing that he says, which is you get your angel investor's license when you make an angel investment, but it expires after 6 months. You need to renew it every 6 months, or you can no longer call yourself an angel investor, which I think is a cute way of saying that. It's often a side gig or a part-time thing, but it's an active type of investment. You need to be out there looking at investments, getting in there and refining your strategy. Again, high skill game. If you want to get good at a high skill game, guess what? You practice. Practice makes perfect. There's always beginner's luck. One of my first angel investments is doing very well. It's also true that it was just beginner's luck because I had no idea what I was doing. So if you want to get good at something, you have to practice. And an angel investment, practice means having the opportunity to make multiple investments over a longer time horizon. And exactly right, Chris. So, there's the sort of the portfolio thing and spreading the risk, but there's also just that practice element, which is really important.
Obviously, doing it multiple times is a big part of that is practice and risk spreading, but a big part of it is just the way startup economics work, right? Startups are hit or fail, win or lose, 0 or 1 games. And we talk about this over and over and over again in the show, avoiding zombie status, avoiding hedging, avoiding, chasing the wrong incentives. And so startups are a uniquely hits-based business, and they're susceptible to power laws and susceptible to all of these things. This is the way the game is played. And so for all of those reasons, practice, portfolio theory, and ultimately just the economics and behavior of startups means that you need to have multiple bets a year and think about that in an active and engaged way. Even though it's a part-time gig and it's not your main job. So we've discussed what is angel investing and who should do it. Now the next question is, why do it? Why would you do it? We've just talked about how high risk it is and how much you need to know and how you need to do multiple checks a year and commit to doing it for multiple years. Well, geez, Yaniv, why on earth do these high net worth individuals get involved in this game in the first place?
Okay, well, let's get the boring one out of the way first, Chris, which is that there is potential for exceptional returns when you angel invest. In the same way as venture capital can benefit from this power law distribution, so can angel investment. If you are skilled and lucky, you need both to do well at this. If you are skilled and lucky, your one investment in some company at a $4 million valuation and it goes to $400 million, gets acquired. That's 100x return. If you think of it in percents, that is 10,000% return on your capital. That's enough to pay for a lot of duds, a lot of zeros. Again, that's that power law thing. And it is enough to give you a massive annual rate of return. So yes, angel investment can make you a lot of money. Isn't that awesome? So that is one reason. But I would also argue, Chris, that if that is your only reason for doing it, then it's probably not worth it. What is it that makes it worth it? To me, it is all of these side benefits that you can stack on top of that potential for exceptional rewards. The first thing that I would say is it is a brilliant way to learn about startups. The problem with startups is either you're an outsider, in which case you get very limited visibility into what's going on, or you're a founder, in which case you get exceptional visibility, but you have an N of one. You have one startup, your own, and so it's very risky to learn too much about how startups work from a single data point, which is your own startup. And so one of the ways to get skilled at understanding how startups work, apart from listening to this podcast, of course, Chris, which is a wonderful way to learn, is to become an angel investor in a whole bunch of startups, because it makes you an insider on a larger portfolio of companies. Whether you aim to be a founder, a better founder, or a founder one day, and you want to get a sense of how the nuts and bolts actually work, what it looks like as a startup goes through its journey, or if you want to become a VC and understand how the journey looks like as an investor, or if you just want to be a member of the startup community and get that feel, that texture of what it's like to be a startup. Being an angel investor, getting those investment memos, getting the highs and the lows when there's a raise, when there's a down round, when something goes to zero, all of that, it gives you not a front row seat, but at least you're not at the back of the stands anymore. It gives you a pretty decent seat into what's happening. So it's just a brilliant way to learn that. So in addition to the financial return, I would argue you get a real knowledge return. You're building your own personal capital as a member of the startup ecosystem.
Absolutely, Yaniv. I think that's all very true. It's a way to be part of the startup journey, whether it's something you're ramping into or something you've just exited out of, whether successfully or unsuccessfully, and you want to continue to play that game. Two additional reasons is the first is you want to give back. It's a form of very material pay it forward. Presumably somebody angel invested in you, somebody invested in you as a VC. People gave you a leg up during your career, or maybe your family is very wealthy and you're like, how can we contribute to making our ecosystem, our community, the next generation better? That's obviously a very good reason to angel invest. And the final one, which I think of a lot, it's a way to participate in startups that is actually, some would argue, smarter insofar as game theory goes. So if you think of game theory, there are single move players, which is really startup founders in the startup ecosystem. They have one move. They have an N of one, as you just said, Yaniv. And so they're building this thing. They're pouring their blood, sweat, and tears into it. If this thing fails, that 2, 3, 4, 5, 6 years of effort is gone. They have no backup plans. They have no parallel investments in terms of time and money. They have no other recourse for that period of time. Whereas if you have a little bit of money and you can angel invest, you can make multiple bets on multiple founders. And as we talked about, have a bit of a portfolio theory and have your skin in the ecosystem without being constrained or tied to one outcome. And so it is a multi-move player in the game theory sense. I guess another one that I thought of just as I was talking is if you just don't fancy yourself as being a good operator, right? Maybe you're a great middle manager. Maybe you're a great incrementalist. Maybe your family has made a lot of money. But you know that you don't have what it takes to grind on your startup ideas every day. You don't want to ride the roller coaster in the front seat, but you want to participate anyway. And you think your unique skill is evaluating ideas, evaluating founders, doing diligence and putting checks in, and you're playing to your strengths. Maybe you come from the private equity world or you come from the banking world and you're like, I know money, I know diligence. Maybe we wouldn't classify you as startup smart money, but that's what I know. I'm going to use my money and put my money where my mouth is.
Yeah, I mean, I semi-agree with you on that last point, although what you described to me is someone who should be seeking a career in venture capital. What you've described to me is a venture capital investor, someone who sees their key skill as evaluating companies and doesn't, want to found their own thing and so on. Yes, That's great for being an investor. Like, again, I think an angel investor, part of where they get their strength is by being involved in the startups in some other way. Being an exited founder, being a current founder, being someone with strong connections into the community, something like that.
But it depends on your access, right, Yaniv? Like there are very limited funds with very limited GP seats. You may not have access to be part of a fund, or you may not want to quit your day job. You like your day job, or you may not want a job because your family's rich, but you still want to participate in a way that doesn't force you to be with nose to the grindstone, right? We may not necessarily classify that set as smart money or as value add.
Yep.
But that may be a reason to do it anyway.
That's fair enough.
And by the way, being an angel investor for that last set might be a way to get some experience under your belt and then go build a micro fund where you might kind of create your own little VC firm and raise get other people's money into your account and start investing their money as well. So it might be a way to build your own fund and build experience for that.
And we're going to talk about angel syndicates in a moment because, yes, there is a sort of a relatively smooth on-ramp from being an angel investor to having your own fund. There's one other thing I wanted to add in terms of why you might want to do this, and that is about building a network. Like you could say this is buying access ungenerously, but you talk about paying it forward. But there's also an immediate payback in terms of if you've invested in a founder and you're doing it in good faith and they see you as a potential value add, they will be, I guess I'll say, grateful to you. They'll look at you in a favorable way, right? They've made room for you on their cap table. You've given them money. You've taken a bet on them. That feels good to them. They will look at you in a favorable light. And so over time, you're getting a portfolio of angel investments. You shouldn't just do one. You're going to have a portfolio of founders who look favorably upon you and might even, in a sense, feel like they owe you a favor if there's one that they can do for you. So it's actually a little bit of a cheat code to build up your network relatively quickly with high-quality founders by putting your money where your mouth is and showing them very concretely that you believe in them and that you are someone that they should be taken seriously.
All right, Yaniv, so that's all the reasons to do it. And, as we've been talking, we've implied some reasons that you might be cautious of. So let's be more explicit here. Why not be an angel investor? Let's just go through that real quick. You may not want to be an angel investor if you're not willing to spend your own money and participate on a long, arduous journey, a very perilous journey that will take many years to play out. It'll have many highs and lows for each of these startups. And you just don't have the stomach for it. And you don't have the ability to put your money in and trust the founder and add value only when invited.
Just a quick tweak on that. As you said, you don't want to participate in a long and perilous journey. But to your point, you're not really participating. What you're doing is you're taking your money and you're sending it on a long and perilous journey to parts unknown, right? And apparently the original venture capital, the original angel investment was in shipping, right? Where you would send a ship to the other side of the world to get spices and so on. If the ship ever made it back, you would be rich. You would make a lot of money. But often the ship didn't make it back. So I think that's the important thing. You wave goodbye to your money. You may never see it again. You need to be able to get on with your life for those years when your money is on that journey.
The other reason, of course, to not do it is if you can't commit to what we discussed around writing multiple checks over multiple years, because your risk profile and your chances of having that big hit is severely diminished. And so if you can't make that commitment, you can't carve up sufficient capital to make multiple bets, I would think twice. And then finally, if you feel like you don't have that high skill component that Yaniv and I talked about, where it's difficult for you to evaluate the quality of the founder, the quality of the idea, the quality of the execution, and or you don't feel well qualified to contribute and add value in the way we've been describing, that might be also a good way to opt out and watch the game play.
Lest we be accused of privilege here, I think it's worth calling out very explicitly that another reason not to do it is you simply can't afford it. There's the kind of dispositional thing. It's like, are you willing to say goodbye to your money and maybe never see it again? But it's also, do you have the money available? Now, I think angel investing has been somewhat democratized and is more accessible than it used to be. And that's something we'll talk about in a moment. But still, it is suitable for people who have enough financial comfort and wiggle room that they can actually carve aside a significant amount of capital for a high-risk investment. So, of course, don't do this with money that you really need. Maybe that's implied, but of course, it's worth noting that you have to have enough money that is, in a sense, disposable as part of your investment strategy for this to make sense.
I mean, let's get even more on the nose about it. The money is illiquid.
Yeah.
Once you put it in, you're not getting it back until the exit or on some kind of secondary offering. So this is in the class of as plain and obvious as the notice on your face. If you don't have the money or you expect to get the money back on demand, that's not happening.
That's right. And I think it's worth noting, like my personal experience, Chris, I've been doing this for quite a few years now. Quite a few of my investments are doing well in the sense that they have raised further rounds at significant higher valuations. So in a spreadsheet, I'm ahead. But guess how much money I have seen in my bank account from all my angel investments?
Zero.
It's a zero, my friend. I've gotten $0 back. And that's normal, right? Because let's say I've been doing this for 4 or 5 years. There's a reason why VC funds operate on a 10-year lifespan. That's what you should be thinking as an angel investor. Before you see any meaningful dollars back, you probably let 10 years elapse. So that's the horizon that you need to be thinking about. Over 7,000 global companies like Atlassian, Dovetail, Flow Health, and Quora all use Vanta to manage risk and prove security in real time. Why aren't you? Get $1,000 off Vanta when you go to vanta.com/TSP. That's VANTA.com/TSP for the Startup Podcast to get $1,000 off. You know what founders hate? All that back office busy work that goes into operating a company. I'm talking about HR, onboarding, offboarding, payroll, EOR, LMS, IT. The list seems endless. And for each of these things, you have a separate vendor, a separate invoice, a bunch of integration headaches. No more. Rippling is doing something miraculous. Building a single all-in-one workforce platform for your global workforce. A single vendor, fully integrated for all your HR and IT needs. So you can focus on what matters, building your startup. They even have a special offer for TSP listeners. Get 3 months absolutely free if you go to rippling.com/TSP. That's rippling.com/TSP for the Startup Podcast. So you've been listening to this and you're like nodding along. You're like, yes, that's me. I want to be an angel investor. I want to start doing this. So let's talk about how you actually get into it and how you do it. And I guess here I'm talking about the mechanisms, although Chris, maybe we can also talk about like the deal flow aspect of it. The most obvious way is what I would call direct angel investment. That means you are basically buying shares in the company and your name is going to appear on that company's cap table. The cap table, of course, is simply the table that defines the ownership, how that pie is split up between its various owners. Direct angel investment normally comes with a minimum investment amount that is set by the founder or founders. And we've been teasing how much is enough money to angel invest? I would say a bit of a convention with direct angel investment is a $25,000 check size is generally considered the minimum investment in order to get you on the cap table. Now, you might be asking, if I only want to put in $5,000, why is someone turning me down? What's the problem with that? So there's a few things. One is, it is additional paperwork for the founder, more owners, more paperwork. Another is that in various jurisdictions, in fact, I believe in most jurisdictions, there is a cap on the number of owners that can exist in a private company. A company, once it has more than a certain number of owners on the cap table, is no longer considered to be privately held. It's considered to be a public company, even if it is not listed on a stock market. And that requires way more compliance. So you do not want to accidentally become a public company. So in a sense, every slot on that cap table is valuable, and you need to put in enough money to generate that value. And the other reason is, again, to do with governance. If you want to sell the company or change something, you raise a round of capital, you need everyone's signature. And so more owners means more admin. Founders generally place a minimum investment on your angel investment, often $25,000, sometimes higher, rarely lower. But there is one interesting wrinkle here, which is this funny reverse negotiation. If you are someone who the founders really want on the cap table because they see you as a genuine asset, a genuine value add in some way, you can get into this funny reverse negotiation where you say, look, I can't afford to put in 25K. My maximum is 15. My maximum is 10. And then the founders have to think to themselves, well, is it worth spending this cap table slot on that person, even though they're putting in a smaller amount of money? Because what we really want to do is actually have their name on the cap table, have access to their advice, be able to say that they're an investor. And so that's sort of the interesting thing. But in general, because of that limit on the number of slots in the cap table, direct angel investment is quite expensive. $25,000, again, doing that maths, Chris, that is implied by what we're saying is, you should be angel investing in a number of companies each year over a number of years. You do the maths on that. And really, if you want to do $25,000 checks, you need hundreds of thousands of dollars set aside for angel investing, which is why it's generally been seen as an elite activity performed by people who are quite wealthy. And, that's true. Hundreds of thousands of dollars in high risk investment, that's something that's not accessible to that many people.
Couple of points on this. The first is, one might be asking, well, why do they want you on the cap table, right? And we've talked before about this idea of signaling. And we talked about advisory boards. We have an episode about advisory boards. If you are somebody with a great reputation or a great resume or great experience, it is helpful to other investors, both in the current round and in future rounds, for the founders to be able to say, hey, that famous person, that effective person, that successful person has invested in us and they're advising us, they're helping us out, and they believe in the business, so should you. That's why you'd have this reverse bidding where they go, look, we'll let you on the cap table for $5,000 or $10,000. We really want you in. We think you're going to add a lot of value to the company, which is coded for, we want your advice, your Rolodex, and your signaling power to other investors. You talked about the 25K number. I think just to generalize this and future-proof this for our listeners many years down the road, I think it depends on your market and it depends on inflation. Some markets are smaller with different currencies and they, whatever, there's fewer angel investors. Maybe they'll take 5 or 10K checks. Some markets are more frothy and more competitive, maybe like Silicon Valley. Maybe they'll take larger checks. The point though is that the founder will typically have a minimum check size, and that minimum check size floats up and down depending on currency values and frothiness and your value as an individual based on your resume, reputation, and so on.
Yeah, and it's worth noting, I typically try to get in on a check size of $10,000 because 25,000, again, using those portfolio construction rules, is a bit much for me, right? So I nearly always end up in a negotiation with the founders, and they're like, damn, we want the co-host of the startup podcast on our cap table. And so I normally get my way, but it's interesting. Okay, so you're sitting there and you're like, damn, I thought I wanted to be an angel investor, and now you're telling me I need hundreds of thousands of dollars to put into angel investing. I don't got that kind of cabbage, so what do I do? Well, there is good news. Let's start by talking about the way you can get into angel investing while skirting around that minimum buy-in.
There is a way around this, and broadly speaking, there are two broad categories powered by one simple idea. The simple idea is that you can set up a separate company. This is often referred to as a special purpose vehicle, and the jargon is SPV. You'll hear people throw this term around all the time, SPV. It's just a fancy name for a dedicated company that is created where all of these potential investors who want to only put in 1 or 2 or 5 or 10K checks, they put all the money into this new company, and that new company, that special purpose vehicle, that SPV, buys the equity in the startup being invested in. And all that money tunnels through the new company into the startup. So if you might have 50 people putting $1,000 checks into the new company then turns around and gives that $50,000 to the startup being funded in return for $50,000 worth of equity. So that way the startup has only one entry on their cap table, special purpose vehicle company X, some random name, generic name, doesn't really matter. And that is one entry so that you're not taking up too many slots. But through that entry, there are 50 small dollar investors, small dollar checks participating via the special purpose vehicle. That is what a special purpose vehicle is. Now, who sets up these special purpose vehicles? Typically, there are two kinds of people who set these special companies up. The first is the founder, because they want all these little checks to come in. I've actually not seen this too often, but Yaniv, it sounds like you have, where the founders themselves might set up a special purpose vehicle, a separate side company, where they can collect investors there and have one entry on the cap table. More often, and very commonly, 1 or 2 or 3 or a number of very proactive angel investors might choose to create what's called a syndicate. And this is where they say, hey, I've done a bunch of diligence on this startup. I like this founder. I like this company. I really want to not just put in my $25,000. I'm going to go to other angel investors, other investors that I know and like, and I'm going to tell them, hey, I have access to this deal. I've sourced this deal, and I've created a special purpose vehicle, a special side company. You guys all invest in this side company as part of my angel syndicate, and this company will then go buy a piece of equity from the startup. Now, the reason this happens is because that very proactive angel maybe has special deal flow. They have special access to great companies. They're perhaps a big believer in the startup and they want to be more proactive. Or, very commonly, they want to make more money out of the deal. And so by organizing this structure, the special purpose vehicle, this syndicate, what typically happens is their reward for doing all the diligence, doing all the admin, setting up the company and so on, their reward is what's called carry. What that means is whatever money is collected in the special purpose vehicle and then invested in the startup, that will have a certain outcome. So let's say you have a 10x outcome, so that the startup becomes 10 times more valuable than when you first invested, or 100 times more valuable. That lead angel who set up the syndicate will have on the deal what's called carry. They'll say, you can invest in my syndicate for typically 20% carry. And what that means is that lead investor gets 20% of the upside of the overall deal. The lead gets the returns they are owed for their $25,000 investment, for let's say, or their $10,000 investment, plus 20% of everybody else's share of the return. So if they raised, this is getting a bit complicated now, but if they raised like $100,000, 25 from themselves and 25,000 from 3 other people, and that 100,000 turns into $1 million, they'll get that $1 million back from the startup. 20% of it plus what's represented by their $25,000 check will come to them, and then the rest will be divvied up amongst the other investors in the syndicate. It's a more sophisticated model, really designed for very proactive angel investors who have lots of high net worth friends and who have access to great deal flow. And in return for that deal flow, in return for the access to those high net worths, and in return for setting up all of that admin, they get that carry.
Okay, so this all sounds really awesome, Chris. And so the question is, okay, if we have this clever hack, the SPV, like why invest directly ever? So there are a couple of things to note. So first of all, the SPV gives you less control, right? Because you are not actually an equity holder of the startup. You're an equity holder of the SPV, which is an equity holder of the startup, which means you probably get fewer information rights. You don't have any direct voting rights. The SPV will vote on your behalf. And so there's just that extra level of remove that can affect you in various ways. It can sometimes affect conversion of share priority and a bunch of other like technical stuff, which normally doesn't matter, but on some specific occasions does matter. All other things being equal, you would rather be on the cap table directly, but of course, all things are not equal. Just be aware of that. It's not usually a big deal. Now, the other thing is, as you mentioned, Chris, when you're in an angel syndicate, normally the syndicate lead takes carry. And that's kind of fair enough. They've done the work. There's quite a lot of work involved. But it's also worth considering what that means is that you are shaving a bit off your return profile. So if making money out of angel investing is hard already, which it is, then doing it via syndicates is that much harder, right? Because you've got all the downside and your upside is uncapped, but it is also, this VIG gets taken out of it, right? The carry gets taken out of it. So you need to have even better outcomes to make the same amount of money. And so again, does that mean you shouldn't do angel syndicates? No, because they add some very real value, including for many people, as we've said, it's the only way to be able to invest at all as an angel investor. It also gives you access often to some of the best deals, but it's just worth being aware. That carry, it might seem free now, but when you have a good exit, you'll be kind of annoyed to have 20% of that taken away by the syndicate lead.
I do want to stress a couple of things here, though. So it's pretty bad form to hear about a deal through a syndicate and go around the syndicate and invest directly. I've actually seen and heard people do that. If someone else is sourcing the deal, getting you access to the deal and putting it together and you're like, oh, actually, I'll just go invest directly, that's, a little bit of poor play. The other thing is, if you are less of an insider than most, this may be the only way to get access to great deals. And so syndicates are really a great thing for you. And if you're not very well qualified to do diligence on a deal and understand how great it is, you may absolutely be wanting to ride the coattails of very proactive, very effective angel investors who run around the world seeing all the best companies, make really great choices, do a lot of diligence, put together great deals. And so, syndicates, I really want to stress, they can be a little more costly, but you're paying, if you choose the right syndicate leader, for a lot of groundwork, sourcing, diligence, and so on. And some of the very best people I know in Silicon Valley, individuals who are not part of funds, do some incredible syndicate work. There's a whole thing called Angel List in Silicon Valley that is very, very powerful. In Australia, one of our mutual friends, I don't know about you, Yaniv, I'm actually an investor in, there is an equivalent of Angel List called Aussie Angels, run by our friend Cheryl Mack. And I'm actually, for full disclosure, I'm an investor in that. And that helps facilitate syndicates and make it easier to build and run syndicates. This is a very powerful idea. It's very popular in Silicon Valley, and it helps people who are very proactive to be rewarded for that proactive behavior, and people who are a little more busy but want to be involved to help ride their coattails and participate in the ecosystem.
And of course, it's worth noting the syndicate leads have skin in the game. I believe that's the rules of most syndicates, is that the lead has to put up a decent chunk of their own money. They're not just rolling up other people's money without putting any of their own cash at risk. Before we wrap up, Chris, I wanted to ask one question. Obviously, the Startup Podcast is all about founders. And one question running through all this, and a question, I've grappled with myself, is should founders be angel investors, right? If you are going in on a company, does it make sense for you to also be operating as an angel investor? Now, as with anything, there are some pros and cons, so I thought we would run through them. The first pro kind of goes back to that why do it, right? Which is, we mentioned at the time, it's a great way to get to see how other startups operate, calibrate, and get a sense of how things happen, what a good practice looks like, how you deal with various sorts of scenarios and crises and who's hiring whom and stuff like that. So it's sort of a great learning opportunity, actually. And also, I mentioned that it's a great way of building your network. And again, if you're an angel investor in other startups, other founders, you start to get access to all of these founders. You have a relationship with them that is actually sealed in something meaningful, which is in your cash. You're not buying the friendship, but what you're doing is you're actually showing that you've got skin in the game of that relationship. And so it can be really valuable, sort of both psychologically and from a learning point of view, to have this network of other founders who you are able to kind of follow along on their journey in a really meaningful way and feel that you're giving them support, sometimes get their support, have that network. I think that can be really valuable, and it's something that I definitely benefited from as a founder. The next pro, and Chris, you kind of indirectly touched on it a bit earlier on, which is to do with spreading risk, right? You said, well, sometimes, a founder in a way is putting all of their eggs in one basket, n equals 1. And, either it kind of goes to the moon and they never have to work again, or they walk away at the end with a big fat zero. More likely the latter, because most startups fail. And so they said that, angel investing is often a smarter way to spread your risk. But the beautiful thing is it doesn't have to be either or. And there's this concept that I learned from poker, in tournament poker, what is very normal, right? So in tournament poker, it's got a lot in common with startups. There is one winner who gets the jackpot. Everybody has to buy in. So you're basically putting all your money into a giant pool, and whoever wins the tournament takes most of that pool away. So everyone's got the same sort of outcome dynamics as in a startup. You most likely walk away with 0. Sometimes you walk away with everything. And while there is a strong element of skill, there is also a strong element of luck. In fact, we did a whole episode once about how startups are a bit like poker. They're a skill-based game with a large element of randomness and luck in any specific instance. So what people do, and this is common practice and is completely legal in poker, is it's called staking each other, right? So that means it's like what you're effectively doing when one poker player stakes another poker player is they will pay a proportion of their entry fee. And if that person wins, they get a proportion of the winnings. So in fact, it is very, very much like buying equity in that person's performance in the tournament. You give them some of the money and you will get some of that reward. And it is normal, again, and common for you to both stake other players and for other players to stake you. So you might end up spending the same amount of money, the entry fee, but you've got a little bit of your downside capped because if one of the other players wins, you get some of that money. And if you win, you share it with other people. You don't get it all yourself. I actually think there is a great analogy between staking in poker and angel investing as a founder, which is to say, again, you're in this community of founders. It's not a zero sum as a poker tournament, but any one of you, you are most likely to lose and much less likely to win big. And so does it not make sense while you are playing this game to buy yourself a bit of insurance to say, well, okay, why not give myself, I've got the big bite at the cherry. I'm still backing myself. I am a participant. The big outcome for me is going to be the outcome of my startup. But why not take a whole bunch of side bets, not big enough to distract you from your core business, not big enough to distort your incentives. What you still want to do absolutely is win yourself, but enough that you've actually not put all of your eggs in one basket. You've spread a few eggs around somewhere else and then let other people do it for you. It's wonderful to have other founders on your cap table. And so I think it's a great way of spreading your risk and kind of building that community and fellowship among founders.
You're making me wish that I did more of this when I was a full-time founder.
Yeah.
I think it's a great way of putting it. I'd never quite thought of it that way, Yaniv. And obviously you think about it as taking multiple bets and multiple moves in the game theory, but think about it as like staking your friends and participating in multiple upsides. But framing it that way makes it feel extremely rational and almost irrational to not do it. That makes a lot of sense.
So let's talk about the con. And it's kind of one con, but with two slight lenses on it. And it's about distraction. We mentioned earlier in this episode, Chris, that angel investing is active investing, meaning you need to invest time and energy and skill into doing it well. You need to look at deals. You need to talk to founders. There's paperwork to be done, blah, 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 right? If you are a founder trying to build your own business, do you want that distraction? Or do you want to be laser focused every day on building your own startup? I think that is a legitimate concern, and that depends on a bunch of things. And Chris, I'd love to get your thoughts on this in a moment, but I also wanted to talk about this twin thing, which is there is a distraction itself, and then there is the perception of being distracted. And, it's not actually uncommon that some VCs do not like to see their founders staking and spreading their risk and focusing on other things because they, as investors, want to see the founders maniacally obsessed on just making that startup succeed. And in fact, they kind of like seeing their founders not have any plan B, right? Like this is one of those areas where VCs and founders can sometimes be misaligned, where the VCs are like, we want that huge outcome and we don't want you thinking you've got any soft landing here, right? You've got to be all in on this thing. And so if you're angel investing in other stuff, that looks to us like you're not all in.
I think that's right, Yaniv. Yeah, I remember, coming up, I was so head down, focused on my startup, and I would see other founders angel investing, and I'd be like, how do you guys have time for this? Like, it's just so distracting. I don't have time to source deal flow and do deals and due diligence, and I just don't understand. I always had in the back of my mind, like, you don't seem very serious about your company. You seem to be doing multiple different things. I wasn't thinking this as signaling. I wasn't thinking of this as like from an investor point of view. I was just thinking of it as like, as a founder who's incredibly busy, I don't know how these other founders are running around doing this other stuff. So I do agree that there is an element of distraction here. And I think it's meaningful, it's material. Now, if you have a few friends on AngelList or on Aussie Angels and you are just like riding their coattails and whatever deal, your friend mates, you just put in 10K, fine, good, excellent. If you're out there sourcing deals, running around, having lunches and coffees and doing diligence and like, give me a break. Focus on your startup, build something of value, and stop being kind of a socialite. It's a little bit too much hedging and a little bit too much distraction. So I think it's about the way you play that game and the way you're perceived to play that game rather than a kind of a hard, fast rule about angel investor, don't angel invest.
One of the ways I think about it is kind of in terms of, we talked about this concept of deal flow, which I think is, again, a fancy term for leads. Basically, here are companies who you're aware of who are seeking investment and might be willing to take investment from you. A serious angel investor invests a lot in deal flow, in getting to look at all these deals and talking to the founders, blah, blah, blah. And that's really distracting. So I think as a founder yourself, you need to find sources of deal flow that are nearly passive. And that's about, other founders and they're raising and you say to them, oh, you already know them perhaps, or you've heard of them, you've got a friend of a friend, and they're like, hey, my friend's raising, they're really good, would you like in? So you've already got kind of this filtering done for you, and you've already got a certain amount of referenceability, credibility for the founder, which honestly, in my view, is one of the bigger things that you need to be thinking about when angel investing. And so the deal flow comes in passively, and you get to take a look at it. And then if it's something exciting, only then do you take the call with the founder and see if it's worth doing. And you don't sort of run this long process. And that's really how I've done my angel investing. The deals come to me. If they're interesting enough, I will pursue them. And, I felt as a founder that did not take up a lot of my time. Your mileage may vary, but I agree that, if you're sort of putting yourself out there, soliciting deal flow and working really hard on it, that's too much time, too much distraction, too much energy that you should be putting into your own startup.
So now I want to say something a little bit controversial, maybe.
Ooh.
The quality of your startup depends on the quality of your people, the quality of your operational experience and talent, and the quality often of your capital and the people who are giving you that capital. And I'm always advising founders I work with to climb up that ladder of quality as high and as fast as they can. Because with working with middling people and with middling investors and with middling execution is going to get you to middling or zero outcomes. It's a waste of time. And I do think angel investing has its own kind of quality. And it all comes down to deal flow. And there are communities and sources of deal flow that are much, much higher quality than others. You want to be careful about the pools and circles and vetting processes that you're involved in.
Yep.
Yaniv, you mentioned like I have a mate who is looking for angel investing and it comes to you passively. And if it's good, you can invest. For my money, if you're going to angel invest, you need to take it relatively serious, even though it's part-time and all that stuff. You want to find syndicates and sources of extremely high quality deal flow from high quality startups and founders. And this can be the difference between getting zero back, getting some money back, and getting massive returns. Deal flow is the secret sauce to investing. VCs spend their entire career almost building visibility, building access, building partnerships, building networks to increase the quality of their deal flow. And that's why most VCs don't even return the fund and most investments go to zero. This kind of thinking is not very popular. It's not very democratic. It's not very egalitarian. But the very best companies come from the very best people and the very best ecosystems. So be careful kind of what rung you're playing in, what pool you're swimming in, and try to get to that deeper water, that higher rung, that better place. It has huge, huge impact on the outcomes. And this is true of startups using different factors, and it's true of angel investing. And as I'm always saying to everybody on this show and in one-on-one advisory is lift your gaze, raise your bar, be more ambitious about the quality of your startup execution and the quality of your angel investing.
Yeah. Look, I semi-agree, like in the sense that I think deal flow is important. I'm not sure it's a secret sauce though. I think you cannot do well as an angel investor if you don't get to see high quality companies. But I actually think the secret sauce is figuring out which companies are high quality. Like it's not easy, right? If it was easy, then all the VCs.
But high quality is relative, right?
I think that's yet another discussion.
I can tell you professional investors out here and professional angel investors out here believe deals flow is everything. It's everything. And then, of course, being able to pick from the very, very best of that high quality set.
I know they believe that deal flow is everything, but I feel like there's a degree to which it's maybe a bit of a kind of a sacred cow that doesn't really get examined empirically. They're just like deal flow, deal flow, deal flow, but then a lot of them don't return the funds. So I'm like, well,
But if they're not returning the fund, Yaniv, imagine what you're going to do. The point is they're swimming in high quality deal flow in a high quality ecosystem and they're still not returning the fund. The last thing you want is to be swimming in low quality deal flow with low quality, sense checking and pattern recognition. You want these things to be high quality, all of them, everything. You want to maximize your chances and probabilities of success.
I nearly feel like we should do a part 2 about like how to assess a company.
Absolutely. That's a great idea. Subscribe now. You heard it first.
You heard it here first. It'll happen. We don't know when. Could be next week. Could be next year.
Actually, I just had lunch with one of my friends who was a product manager at Uber, who is now a partner at Greylock. And we were actually talking about how after a certain amount of experience, both investing and advising, you can tell who the great founders are in great companies really quick. And there's a really strong sense of pattern recognition. And we talked about actually the kinds of founders you see and the personas and personalities and patterns you notice. Now, some of this is bad because it's like your pattern matching can be actually a form of bias, unconscious bias, and limit out certain people and communities of people. But some of it is actually developing a feel for what works in startups and in investing. And as you said, Yaniv, earlier on in the episode, this takes practice, it takes experience, and takes a certain amount of time to see how things play out.
So Chris, you just talked about pattern recognition. That's something that comes from experience, and it's important for investors. It's important for founders as well. So folks, if you are listening and you want to take advantage of Chris's incredible pattern recognition, Chris, I know that's what you do in your advisory work. So how can people contact you?
Yeah, that's right, Yaniv. Investors can tell pretty quickly if you're the right kind of founder talking about the right kind of things. And that's generally what I help with in terms of fundraising, narrative, and getting in front of the right investors. So if that's of interest to you, check out chrissaad.com/advisory. You can learn more there and contact me from that page. And Yaniv, how can people find you on the internet?
Okay, so I'm mostly on LinkedIn. I'm the only Yaniv Bernstein on LinkedIn. I love a connection from TSP fans, so just let me know in the connection request that you're a fan and I will accept it. I'm also on X, although less and less again recently.
All right, Yaniv, great chat as always.
Likewise, Chris. Have a good one. Today's episode of the Startup Podcast was brought to you by Vanta. Vanta automates compliance for SOC 2, ISO 27001, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies already use Vanta. Why don't you? Get $1,000 off Vanta when you go to vanta.com/TSP. That's VANTA.com/TSP for the Startup Podcast to get $1,000 off.